Today, we will talk about interest expenses, how they work, coverage ratio explained. Interest expense is the cost incurred by an entity for borrowed funds. It's a non-operating expense shown on the income statement and represents interest payable on any borrowings including bonds, loans, or lines of credit. It's calculated as the interest rate times the outstanding principal amount of the debt. Interest expense on the income statement represents interest accrued during the period covered by financial statements, not the amount of interest paid over that period. For most people, mortgage interest is the single biggest category of interest expense over their lifetimes, as interest can total tens of thousands of dollars over the life of a mortgage, as illustrated by online calculators. Interest expense often appears as a line item on a company's balance sheet since there are usually differences in timing between interest accrued and interest paid. While mortgage interest is tax-deductible in the United States, it is not tax-deductible in Canada, and the loan's purpose is critical in determining the tax deductibility of interest expense. The amount of interest expense has a direct bearing on profitability, especially for companies with a huge debt load. Heavily indebted companies may have a hard time serving their debt loads during economic downturns. At such times, investors and analysts pay particularly close attention to solvency ratios such as debt to equity and interest coverage. The interest coverage ratio is the ratio of a company's operating income to its interest expense. This measures a company's ability to meet the interest expense on its debt with its operating income. A higher ratio indicates that a company has a better capacity to cover its interest expense. For example, a company with $100 million in debt at 8% interest has $8 million in annual interest expense. If annual EBIT is $80 million, then its interest coverage ratio is 10, which shows that the company can comfortably meet its obligations to pay interest. Here are 3 key takeaways. 1. An interest expense is an accounting item that is incurred due to servicing debt. 2. Interest expenses are often given favorable tax treatment. 3. For companies, the greater the interest expense, the greater the potential impact on profitability. Coverage ratios can be used to dig deeper. Hope this would help. Thanks for watching.